So now we're going to take a look at an actual loan estimate. This one is from 2013. It's still residing on the CFPB, the government website where they first started talking about the new form. And this is all the way from 2013, so 2 years before it actually even went into effect. So you're going to find that every state has different fees, and these are definitely old fees because they're a lot less than what you're going to find today in the market. So the first date that we want to really pay attention to is the date issued. In this case, 2/15/2013. Remember, we've got the 6 items of an application, and so once those are taken, the application, the loan estimate has to go out within 3 business days. Those exclude holidays, those exclude Sunday, and so in the case of say a Thursday application, you're going to have Friday, Saturday, Monday. Unless there's a holiday in there, then it would be Tuesday. But that is important about the date. Then we go and we've got name, the current address where you're living, and then the subject property and the sales price for $180,000. The terms are the loan terms, so that could be a 30-year fix, it could be a 15-year fixed. The purpose, is it a purchase or a refi? And then the product, is it a fixed rate, so a 30-year fixed, a 10-year fixed where the principal and interest payments are the same, or is it an ARM where it's an adjustable rate mortgage where the rate can change and therefore the payment can change? The loan type, so it states conventional FHA, VA. There also is another loan called the USDA, but that is an other loan. The conventional, when you hear Fannie Mae, Freddie Mac, that's a conventional loan. So it meets conventional guidelines, and so that way it can be sold to Fannie and Freddie. You know, a lot of people talk about you have to put 20% down on a conventional loan. That's absolutely not true. You can do 3% down if you're a first-time home buyer, 5% down, but you're just going to pick up PMI, private mortgage insurance, which we'll talk about in a minute. The FHA is Federal Housing Authority, that is HUD, and that lets you put 3.5% down, and that's a government loan. You're going to always have upfront mortgage insurance on that, and then you're also going to have ongoing mortgage insurance on the FHA, but the rate's usually a little bit better. The VA is a great benefit if you're a qualified veteran and you're eligible for the VA. It lets you put as little as 0 down and no mortgage insurance. You may have a funding fee unless you've got 10% disability, but that's another great loan. So next we have the rate lock, and in this case the rate is locked until 4/16/2013 at 5 p.m. So you want to know if your rate's locked or not, because if it's not locked and the rates get worse, then the rate can get worse on you. So loan amount under the loan terms is $162,000. So in this case you can see you're putting approximately $18,000 down, and the interest rates in that case was 3.875, which would be really nice to have right now. So your P&I, principal and interest, monthly payment will be $761.78. Does it have a prepayment penalty? In this case it says yes, but you're going to find that there are no prepayment penalties on conventional or government loans. And the balloon payment, you're going to not have a balloon payment on government loans either. On non-QM, which are non-qualified mortgages, which kind of don't meet the regular guidelines, or on a bridge loan or a hard money loan, private money loan, you may have a prepay or a balloon, but in this case you don't. So projected payments, your payment calculation 1 through 7 is that principal and interest of $761.78. In this case, because you're putting less than 20% down, you're going to have PMI, which is private mortgage insurance, which is just an insurance policy to protect the lender should there be a foreclosure by the borrower. Because they put less than 20% down, they need to make sure that they're insured and that they're going to be able to be made whole. So that goes for 7 years in this case, and then it falls off. This is the escrow account, principal or your insurance and taxes. And in this case, it's $206 for taxes and insurance. So your total payment is going to be $1,050 until your PMI falls off, when it's going to be $968. Estimated taxes and insurance. Yes, it has the taxes built in. Yes, it has the insurance built in. On an impound account, the lender is paying your insurance for you on an annual basis, and typically the taxes twice a year, at least here in California. Other states are different. You're going to have $8,054 in closing costs. which is 5672 in loan costs, and then 2382 in other costs. And then in this case, there is no lender credit. And then you're going to have estimated cash to close of $16,054. So how are those numbers made up? Well, that's page 2. So if we go to page 2, box A, you've got a quarter of the loan amount in points, $405 in this case. And then you've got an application and an underwriting fee. Those are typically lender fees that go into the loan. So you're going to find that underwriting fees are typically anywhere from, say, $950 to $1,500 on most loans. And let's talk a little bit about the quarter point cost. On some loans, you're going to have a buy down so that you get a little bit better rate. In this case, we get the 3.875. And then sometimes you take a higher rate. So let's say in that case you had a 4.125. Well, you may be getting a credit that can be applied to your closing costs and prepaids. Box B, services you cannot shop for: appraisal fee, credit report, flood determination, flood monitoring, tax monitoring, and status research fees. These are all independent third party that you don't choose, that are chosen for you. And we're finding that a lot of times these are a lot more expensive. Right now, appraisals are going for more like $650. Credit reports are somewhere between $75 and $100. Services you can shop for in box C: pest inspection fee, really important. If you're doing anything other than a VA loan, you don't want to write the pest inspection into the contract unless it's something that you want to have to fix prior to closing. In this case, on a VA loan, in a conventional loan, I wouldn't recommend putting that in there, but you can, and then you'll just have to fix anything that comes up prior to that's a Section 1 or Section 2 clearance. So survey fee, fees that you're going to see on California settlement statements or LEs are going to be the lender's title insurance, which is protecting the lender to make sure there's no mechanic lien against the property. Settlement agent fee, which is your escrow fee. And then there's also an owner's title policy, which protects you as the owner. In that case, it's $1,000 here. And then title search, depending on where you are, you may or may not have that. Other costs, so taxes and other government fees. In this case, the recording fee and transfer tax. This is a good time to talk about who pays what. There are 4 items that the seller is typically going to pay. 50-50 on escrow. They typically pay the owner's title policy, which is the more expensive title policy. They typically pay the transfer tax and the home warranty. It's all negotiable, so when you are working with your agent, you'll decide which ones you want to negotiate for or not. So prepaid items, those are monies collected up front. They are not closing costs, they're just set aside. So in this case, homeowners insurance premium 6 months. That's not accurate. It's going to be 12, almost always. Your mortgage insurance premium, you may or may not have that. Typically don't see anything there. Prepaid interest, so whatever day you close of the month, the remaining days of that month, you're going to pay up front. You're going to skip the full month the next month, and your first payment will be the following month. And then property taxes. So in this case, it's saying no property taxes, but in California, depending on which month you close, you'll pay prorated taxes for whatever is left in that pay period, and then the seller will pay whatever they are responsible for. Here's your impound account. So when you're looking at an impound account, you've got your initial escrow payment at closing. So homeowners insurance, that'll typically be 3 additional months. Mortgage insurance probably will not be anything, and then property tax will be dependent on which month you close. So if you want to know what that is, just give a call. We're happy to share that with you. Here's your title owners and title policy that typically the seller would pay. In this case, they're not. And then here's a breakdown of your total closing costs, $8,054. That's taking D, which is these numbers here, and then I, which is these numbers here, and that's your total of $8,054. Calculating the cash to close. This is breaking down all the numbers. So the $8,054 in closing costs. Your down payment is $18,000, and then your deposit that you put down when you went into contract, and you usually need to get that in within 3 business days, was $10,000. It may be $1,000, it may be $10,000, could be $50,000. Depends on how you're writing your contract. In this case, there are no seller credits. You'd usually see seller credits because of the things that the seller's paying, and then any other adjustments. But in this case, the estimated cash to close is going to be our down payment of $18,000 plus our closing costs minus our deposit is $16,054. On page 3, you're going to see additional information about this loan. So Fiscus Bank, in this case, just a made-up bank, name, NMLS number of your loan officer, email, phone number, and their additional information. So here's what you're going to see, comparisons, so that you can see what is the comparison on this loan. $56,582 is the total you're going to have to pay in principal and interest, mortgage insurance, and loan costs over the first 5 years, and then $15,773 in principal that you're going to pay off. Your APR is 4.274, so that's your shoppable costs plus your interest rate divided over the 30-year loan. So even though the rate was back here at 3.875, your APR with the closing costs are going to be 4.274. So people a lot of times say, well, what's my interest rate? Well, it's the 3.875. Your total interest percentage, the total amount of interest that you're going to pay over the long term of the loan as a percentage of your loan amount. And then just some other considerations, appraisal assumptions, homeowners insurance, late payment, refi, servicing, and this is additional information about your loan. So that's a little bit about the loan estimate and how it works. So what I'm going to take a moment and do is show you what a mortgage coach tool looks like that we do before the loan estimate so that you get an idea of what a loan looks like. So I'll show it to you right now. All right. So here's a loan that we put together recently on 9/30 of 2023. They're doing 4 different scenarios. So one is a 30-year FHA loan at a purchase price of $420,000. One's a 30-year FHA with $420,000 zero credit. Here is $9,500 credit, and then here is using a down payment assistance loan. So here's your loan amounts, your interest rates today, your APR, your term, so 360 months, payments, cash to close, and then your monthly savings on each of those scenarios. And what's real important is we're looking, especially as first-time home buyers, when we're looking at putting less money down, these are scenarios that we can really look at and say, okay, what's our best solution? And then we can put a graph and show what the monthly payment difference is, savings over 60 months, and interest in MI paid in 15 years. So you can see it's a lot more dynamic. And we do that prior to going into contract, so you know exactly what you're looking at. So if you have any questions, please feel free to reach out. You'll see our number below. Happy to answer your questions, help you get ready to get into contract and get the best deal in the market. Have a great day.